All right, everyone, buckle up. The crypto world never sleeps, and neither do we here at Bitcoin Bulletin. Get ready for a rapid-fire update on the news that's shaking the foundations and setting the pace for what's next. We've got seismic shifts in how global finance giants are viewing digital assets, a jaw-dropping transaction from a long-dormant whale that's rewriting the rules of decentralized finance, a bold move from a major tech firm that could signal a new era for corporate treasuries, and a surprising turn of events for those institutional products you've been watching. This is the intel you need to stay ahead of the curve. Let's dive in. First up, the titan of finance, BlackRock. Their CEO is now calling Bitcoin digital gold, a massive pivot that's got everyone talking. We're diving deep into why this legendary investor sees Bitcoin as a hedge against a fractured world and how their own ETF is becoming a powerhouse, gobbling up Bitcoin like never before. You won't want to miss this evolution in institutional thinking. Then, hold onto your hats because a 13-year-old Bitcoin wallet has just woken up, and it's made a $10 million splash. We're talking about a move so massive, so efficient, and so private, it's practically a masterclass in decentralized finance. See how this whale bypassed traditional gatekeepers and showcased the raw power of DeFi in a single, lightning-fast transaction. Next, we're looking at the tech sector and a company making a truly audacious play. This firm is betting big on Bitcoin, planning a massive capital raise to acquire more. Could this be the next big trend for how tech companies manage their treasuries? We're exploring the strategy, the risks, and what it means if others follow this bold path. And finally, a reality check for the institutional world. Those Bitcoin ETFs that have been so hot, they're now facing a significant sell-off. We're breaking down the outflows, the reasons behind the shift, and what this means for the broader institutional optimism that's powered the market. Is this a blip or a major trend shift? We've got the analysis. Stick around, because this is the news that matters. Don't forget to hit that like button, subscribe, and ring that notification bell so you never miss an update. Financial giant shifts stance on digital gold. BlackRock CEO Larry Fink has dramatically altered his perspective on Bitcoin, now referring to it as digital gold and a crucial hedge against currency debasement. This significant evolution in his view marks a departure from his previous skepticism, where he often highlighted Bitcoin's association with illicit activities. Fink's updated stance is informed by practical, real-world use cases that demonstrate Bitcoin's utility, particularly in economically unstable regions. He pointed to instances like wage payments in Afghanistan facilitated through Bitcoin, allowing individuals, especially women, to receive compensation despite restrictive local financial systems. This practical application, coupled with the accelerating pace of institutional adoption, has evidently swayed his opinion on the asset's inherent value and potential. Fink articulated that Bitcoin does not aim to replace traditional fiat currencies, but rather serves as a financial instrument that responds to fear and uncertainty. This perspective positions Bitcoin as a store of value, akin to gold, offering a sanctuary for capital during times of economic distress and currency devaluation. His comments resonate with a growing narrative within institutional finance that acknowledges Bitcoin's role as a potential portfolio diversifier and a hedge against systemic financial risks. The increasing integration of Bitcoin into mainstream financial products, such as exchange-traded funds, further validates this narrative and signals a broader acceptance within the established financial industry. BlackRock's own iShares Bitcoin Trust, IBIT, has emerged as a dominant force in the market, rapidly accumulating over 781,000 BTC. This substantial holding positions BlackRock as the second-largest Bitcoin holder globally, surpassing major cryptocurrency exchanges. The ETF's rapid ascent is attributed to its innovative structure, which removes Bitcoin from circulation through a unique supply-reducing mechanism. Unlike Bitcoin held on exchanges, which can be recycled for trading, the BTC held by IBIT is effectively locked away, contributing to supply scarcity. This sustained demand, combined with the inherent supply shock created by the ETF's mechanics, is widely seen as a significant factor underpinning Bitcoin's price stability and potential for appreciation. Fink also highlighted two key trends poised to reshape institutional finance, tokenization, and artificial intelligence. His forward-looking statements suggest that digital assets and advanced technologies are central to the future of financial services. This perspective underscores a paradigm shift where traditional financial institutions are not only exploring but actively integrating digital assets into their strategies, recognizing their potential to enhance efficiency, security, and accessibility. The institutional embrace of Bitcoin, as exemplified by BlackRock's evolving stance and the success of its ETF, signals a maturing market where digital assets are increasingly viewed as legitimate components of sophisticated investment portfolios. The market's reaction to Fink's pronouncements has been largely positive, with many interpreting his comments as a significant endorsement that could further legitimize Bitcoin in the eyes of traditional investors. Analysts point to the increasing inflows into Bitcoin ETFs as evidence of growing institutional confidence, despite the inherent volatility of the asset class. The strategy of removing Bitcoin from circulation via ETFs is also a key talking point, with many believing it could create sustained upward pressure on prices by limiting available supply. But is this institutional embrace a sign of stability or a precursor to something else? We'll see how a newly active, decade-old Bitcoin wallet is making waves in the decentralized finance space. Dormant whale awakens. $10M Bitcoin move redefines DeFi efficiency. A staggering $10 million Bitcoin transaction has just been executed by a previously dormant whale, utilizing the decentralized exchange AxioraSwap. This monumental move originated from a Bitcoin wallet that had remained untouched since 2010, making it one of the earliest active mining addresses on the network. The entire operation, involving the conversion of Bitcoin to USDT, was completed in a mere 14 minutes and a single on-chain transaction, as detected by blockchain intelligence firm Arkham. This event not only highlights the immense value held in early Bitcoin holdings, but also showcases the remarkable efficiency and privacy offered by advanced decentralized finance protocols. The whale's choice to leverage AxioraSwap over traditional financial avenues like centralized exchanges or over-the-counter OTC desks underscores a growing preference for platforms that offer greater autonomy and lower costs. Unlike conventional services, AxioraSwap facilitated this massive trade without requiring any Know Your Customer, KYC verification, account creation, or regulatory compliance checks. The total transaction cost was a mere 0.15%, a fraction of the 2–3% typically charged by traditional intermediaries for such high-value trades. This significant cost saving, coupled with the absence of intermediaries, demonstrates the power of trustless, permissionless financial infrastructure in the digital asset space. AxioraSwap's underlying technology is a fully decentralized cross-chain infrastructure that enables native swaps between major cryptocurrencies like BTC, ETH, SOL, and XRP. A key feature is its ability to operate without the need for wrapping, bridging, or custodial delays, which are common pain points in many cross-chain solutions. Uniquely, AxioraSwap does not require users to connect their wallets to initiate a swap. Instead, users simply send their assets to a unique, protocol-generated deposit address. The platform then automatically handles the entire conversion process and delivers the desired assets to a specified destination address. This streamlined, non-custodial approach prioritizes user control and security. This transaction serves as a compelling case study for the maturation of decentralized finance, DeFi. It illustrates how platforms are now capable of providing institutional-grade services within a permissionless environment. The whale's decision to move such a substantial amount of Bitcoin through a DeFi protocol, prioritizing cost-effectiveness, speed, and privacy, signals a potential shift in how large capital movements are conducted. It reinforces the viability of DeFi as a robust alternative to traditional financial systems, offering greater control and transparency for asset holders. The broader implications for the crypto market are substantial. As more users, particularly those with significant holdings, explore decentralized alternatives, the demand for efficient and secure DeFi solutions like AxioraSwap is likely to increase. This trend could accelerate the adoption of DeFi for a wider range of financial activities, from trading and investment to payments and asset management. The ability to bypass traditional gatekeepers and conduct transactions with greater privacy and lower fees represents a significant step forward in realizing the full potential of decentralized finance. The community's reaction has been one of awe and validation for the DeFi space. Many see this as proof that decentralized protocols can handle large sums with efficiency and security that rival, if not surpass, traditional finance. The low fees and speed are particularly praised, highlighting a more user-centric financial system. This massive DeFi play shows the power of decentralized systems, but what about the tech world's own foray into digital assets? We're about to uncover a major tech company's bold Bitcoin strategy that could redefine corporate treasuries. Tech firm bets big on Bitcoin, a new treasury strategy. Sequans Communications is making a bold move into the cryptocurrency space, planning to raise up to $200 million specifically to acquire more Bitcoin. This significant investment strategy positions the company as a potential trendsetter in how technology firms manage their corporate treasuries, especially in the current global economic climate marked by inflation and uncertainty. Sequans' decision places them alongside other prominent tech companies like MicroStrategy and Tesla, which have already integrated Bitcoin into their financial strategies, signaling a potential shift in corporate finance paradigms. The company's rationale appears to be rooted in a belief in Bitcoin's long-term value proposition as a store of wealth and a hedge against currency debasement. By earmarking substantial funds for Bitcoin acquisition, Sequans is signaling confidence in the digital asset's ability to preserve and grow capital over time. This strategy, however, is not without its risks. The plan to fund this acquisition through the issuance of new shares could lead to dilution for existing shareholders. Furthermore, the company's financial performance will become increasingly intertwined with the volatile price movements of Bitcoin, creating a dual dependency on both the cryptocurrency market and Sequans' core Internet of Things (IoT) business. The market's reception to Sequans' plan has been mixed, with the company's stock price reflecting a degree of caution. The discount at which the stock may be trading could be an indication of investor apprehension regarding this Bitcoin-centric strategy. Analysts suggest that while the potential rewards of a rising Bitcoin price are significant, the inherent volatility and the need for robust risk management cannot be overstated. The sustainability of such a strategy for tech companies, especially those with fluctuating core businesses, remains a key question. Navigating the regulatory landscape is another critical aspect of this move. Companies like Sequans must contend with evolving regulations, such as the EU's markets in crypto assets (MiCA) law, which imposes strict requirements related to anti-money laundering, AML, and counterterrorism financing, CTF. Adherence to these regulations is paramount for any firm looking to engage in significant cryptocurrency holdings and transactions, ensuring compliance and mitigating legal risks. Beyond treasury management, Sequans' embrace of Bitcoin could also influence other areas, such as the growing trend of crypto payroll solutions. In regions like Asia, where economic instability and high traditional banking costs are prevalent, startups are increasingly adopting crypto payrolls for their efficiency and cost-effectiveness. Using stablecoins like USDC or USDT can help mitigate currency fluctuation risks, making crypto-based payroll a compelling option. Companies that facilitate such solutions, like Rise and Bitwidge, are enabling faster, cheaper, and more transparent cross-border payments. Sequans' strategic investment in Bitcoin could serve as a catalyst, encouraging other tech firms with strong balance sheets to explore similar avenues. If this move proves successful and reinforces confidence in cryptocurrencies, it may spur wider adoption within the corporate sector, particularly for innovative financial tools like crypto payroll. As the corporate treasury landscape continues to evolve, Bitcoin's role may expand significantly, although it necessitates careful consideration of associated risks and regulatory compliance. The community is watching closely, with many seeing this as a potential turning point for corporate adoption of Bitcoin. The debate centers on whether this is a forward-thinking strategy or a high-risk gamble that could jeopardize shareholder value. This tech firm's bold Bitcoin bet highlights a shift in corporate finance. But what's happening on the institutional investment front? We're about to dive into the unexpected sell-off hitting Bitcoin ETFs and what it means for institutional optimism. Bitcoin ETFs face sell-off amid shifting institutional sentiment. Bitcoin exchange-traded funds, ETFs, are experiencing a significant outflow of assets, with investors withdrawing approximately $33.6 billion over a recent 6-day period. This trend signals a notable shift in institutional sentiment, driven by a confluence of factors including heightened regulatory uncertainty, persistent inflation concerns, and the impact of interest rate hikes. While the second quarter of 2025 saw record institutional inflows into these products, the recent outflows suggest a recalibration of risk appetite among major investors. Earlier in the year, institutional adoption of Bitcoin ETFs was robust. Data indicated that by the end of Q2 2025, institutional investors had amassed $33.6 billion in holdings across various Bitcoin ETFs. Investment advisors were at the forefront, accounting for $17.4 billion of these positions, outstripping the combined holdings of hedge funds, brokerages, and holding companies. Notable institutional players like Brevan Howard Capital Management significantly increased their stake in the BlackRock iShares Bitcoin Trust, IBIT, boosting their holdings by 71% to 37.5 million shares. Furthermore, the Harvard Management Company made a substantial entry into the market with a $117 million investment in IBIT, underscoring a strong institutional commitment at the time. However, the market dynamics have recently reversed. The current outflows are broad-based, affecting both large institutional players and retail investors, indicating a widespread investor caution. Analysts attribute this shift to growing anxieties about the broader economic environment, including the potential for economic slowdowns and the ongoing impact of monetary policy tightening. Market corrections in traditional asset classes have also prompted a reassessment of risk across investment portfolios, naturally extending to digital assets like Bitcoin. The role of ETFs in driving crypto adoption, particularly among retail investors, remains a key discussion point. In markets like Australia, ETFs are seen as a primary vehicle for crypto access, with most flows originating from individual investors rather than financial advisors. This disparity highlights a potential gap in regulatory clarity and advisor comfort, as many trustees and licensees currently restrict cryptocurrency exposure in client portfolios. The strong performance of products like VanEck Bitcoin ETF, which amassed $290 million in its first year, demonstrates the underlying demand, but its accessibility for broader financial advice remains constrained. With 75% of Bitcoin ETF shares reportedly held by non-filers, predominantly retail investors, the market's behavior can be more susceptible to short-term price fluctuations. This concentration of retail ownership raises concerns about market volatility and the need for more advisor-friendly regulatory frameworks. The sustainability of institutional interest is now being tested, as these investors reassess their exposure in light of current macroeconomic risks and the evolving regulatory landscape. Regulatory developments and global economic trends will significantly influence the future trajectory of Bitcoin ETFs. Central bank policies aimed at curbing inflation are under close scrutiny, as they can directly impact asset valuations. The coming weeks will be crucial in determining whether these outflows represent a temporary market correction or the beginning of a more sustained downturn, casting a shadow over the previously optimistic outlook for Bitcoin ETFs. Market participants are keenly observing these developments, seeking clarity on regulatory frameworks and macroeconomic indicators that could shape investor confidence and market stability in the near future. These institutional outflows paint a picture of caution, but the overall crypto market continues to evolve rapidly. That's all the top stories for today. Let's do a quick recap before you go. And that's a wrap on today's essential updates. We saw BlackRock CEO dubbing Bitcoin digital gold, a massive $10 million Bitcoin transaction from a decade-old wallet making waves in DeFi, a tech firm planning a huge Bitcoin acquisition that could set a new trend, and a surprising sell-off hitting Bitcoin ETFs. Stay informed, stay ahead. If you found this breakdown valuable, smash that like button, subscribe to Bitcoin Bulletin for your daily dose of crypto insights, and ring that notification bell so you're always in the loop. Don't forget to follow us on all social platforms for more exclusive content and join the conversation in the comments below. We'll see you in the next one.